Hi, JJ here with The Art of Value. Welcome. Well, this week's a bit of an Alibaba week for me. I'm going to do two videos. The first is about the fiscal year 2023 full year results and about the overall company. And the second video coming up next will be about the 6 business segments individually, because they're planning to break them off, eventually IPO them all, and we'll take a look at those a bit more in depth. So let's get into the first one. It's about Alibaba, the overall company, the overall stock as I see it. It's a bit of a controversial stock on the stock market. If you look at FinTwit, it certainly is. People either sort of love it or they hate it. Nobody really questions that it's undervalued. It's really just the geopolitical situation, investing in China, people's different opinions on that, and they do have differing opinions on that for sure. So I'm one of the shareholders of Alibaba. I'm holding on to it. Charlie Munger still owns it. Mohnish Pabrai sold out of it. So this is about looking at Alibaba, the company, and their financial situation, how they're actually doing as a company, not the stock, because sometimes people don't often look closely enough at that. So let's see how they've done over the past year and over the past quarter, and what they might be doing going forward over the coming years. Well, the Alibaba Bears have certainly been winning so far. It's down over 70% since its October 2020 high. That's a long time ago now. The company itself is doing okay, increasing profitability, although slower revenue growth, which we'll see when we go through some of its earnings for the last quarter and the last year. If I were to sum it up before we even get going, getting into the detail, it's modest revenue growth, improved profitability, and enhanced cash flow generation through the last quarter, and increasingly so. The company's got a lot of cash, which we'll see. The company continues to repurchase shares at a good rate, and they're preparing to spin off these 6 segments over the coming years, the first not too far away. One of the things that's changed is the easing COVID restrictions in China in this last quarter. And it's one of the things that investors have been put off investing in China and investing in Alibaba. But we're going to see some more normal quarters if this keeps up. Who knows what's going to happen? But it's definitely normalizing from where it was a year ago, or deep into the restrictions that they had, the harsh restrictions. In this last earnings release, the CEO Daniel Zhang and the CFO Toby Zhu talked about the company and the current situation and what they're planning to do. Management did talk about the COVID restrictions and how that did dampen consumer spending, including for e-commerce with Alibaba, and that it started to normalize around February 2023, so not long ago at all, and it did cut into this last quarter. So Alibaba overall recorded a modest 2% revenue growth and a 16% increase in adjusted EBITDA. The shareholder Charlie Munger wouldn't be so happy with them using that measure, but they do, and a 15% increase in cash flow for the last quarter, which is pretty good. So a low, modest revenue growth, but definitely a decent increase in cash flow for the quarter. In his opening remarks, CEO Daniel Zhang did acknowledge the difficulty of the operating environment in China with the COVID restrictions, but he did say that cases were declining very quickly, COVID cases, but he also acknowledged the difficulty in the macro environment, not just in China, but deteriorating worldwide. We've seen a number of CEOs from different companies saying that worldwide, not just in China, about the macro environment deteriorating over the last couple of quarters, anticipating a possible recession, and it's been difficult in China because of these COVID restrictions and dampening consumer demand. He said in response to these uncertainties, Alibaba was focusing on 3 core strategies: consumption, cloud computing, and globalization. Zhang mentioned an improvement in consumer spending since the lockdowns, but he also mentioned increasing competition for the consumer dollar, for the consumer spend, which is not really a great thing you want to hear as a shareholder. Increasing competition, shareholders would like things that have a sustainable competitive advantage and decreasing competition. So he said Alibaba was focusing on retention and acquisition of high quality users, maintaining a differentiated consumer mindset on the platform, and creation of new demand through supply side innovations. Focusing on the restructuring announcement, he said that Alibaba was transitioning to a holding company focused on capital management. I'll talk about each business segment in my next video, but at the moment, Zhang said that each company would be responsible for its own trajectory, its own performance, and have supervision from its own board and its own CEO. So the big announcement here is that the Cloud Intelligence Group will be spinning off into its own company within the next 12 months. So its IPO will be in the next 12 months. Further to that, they said the board had approved plans for the IPO process for Fresh Hippo, and that will take about 6 to 12 months, this process. So another IPO quite soon after that. And they're also planning to explore the KaiNow IPO in the next 12 to 18 months. So IPO after IPO, they really seem to be getting on with this process of listing these 6 business units. By the way, if you're watching on YouTube, I really appreciate you hitting that like button to help spread it to more people, help with visibility. And we're now well over 1,000 subscribers and followers on YouTube and on Spotify, the 2 main video platforms. So if you're enjoying this episode, if you like this kind of content, maybe consider subscribing to watch more of this in the future. In addition to this, Alibaba International Digital Commerce Group plans to raise capital to expand in the international market. In this release, CFO Toby Zhu provided details on the mechanics for the cloud spin-off coming up and how Alibaba Group will approach capital allocation for all these new businesses spinning off, these new independent businesses. They plan to set up a capital allocation committee with 3 main priorities. They are maintain the strength in the balance sheet and cash position as a competitive advantage in uncertain environments, with focus on improving return on invested capital and managing company assets. Return on invested capital, important there for investors. We'd like to see that. Number 2, implement earnings per share enhancing activities such as consistent share buybacks to reduce outstanding share count while managing employee stock option programs. Buybacks, maintaining that buyback program, another thing that shareholders like to see, taking that share count down. And number 3, explore all options to enhance shareholder return, including subsidiary financing, IPOs, and spin-offs, while improving transparency in asset value. In terms of fundraising, the main funds they say will actually be from Tmall and Taobao, which are wholly owned and generate substantial free cash flow. In fact, in fiscal year 2023, Alibaba generated $25 billion in free cash flow, mainly generated by these businesses. So they announced that the board has approved a full spin-off of the Cloud Intelligence Group via a dividend distribution to shareholders. So to sum up so far, they're restructuring into 6 separate business units. They've got plans for the first IPO of the cloud business and potential plans for IPOs for KaiNow and Fresh Hippo already in the works. And more details of IPO plans coming throughout the year, no doubt. Now a quick overview of financial results. As I said, they had a 2% year-on-year revenue growth, pretty modest, and a 9% decrease in income from operations. But that income from operations number had quite a few one-off adjustments, so it's not really meaningful or accurate for the year. We also have to remember that that number was affected by the COVID lockdowns, the restrictions, and dampening of consumer demand, so not really normal. It'll be interesting to see what happens in the next year or two as things normalize, if that actually happens. In terms of the company's cost structure, it seems that the heightened competition was managed pretty well. Costs as a percentage of revenue were either flat or down. So the reduction of costs positively affected margins, leading to increased cash flows for the business, which is, of course, a good thing for shareholders to see. The cash flows for Alibaba tend to be somewhat seasonal, being retail-based, retail e-commerce, but the $4.7 billion free cash flow that was in the fourth quarter was a record for the fourth quarter, not a record for any quarter, but pretty positive and pretty encouraging to see that. It was pretty encouraging compared to last year's negative cash flows. Of course, that was COVID affected, so that's no surprise there. So how are they using these wonderful cash flows? Well, in the last quarter, they repurchased $1.83 billion worth of American depository receipts, their ADRs, which was less than the quarter before, but a substantial amount of repurchasing going on, which again, a lot of shareholders like to see that repurchasing, lowering the share count. However, this was somewhat offset by the issuing of new shares, the share compensation program, but they are repurchasing more than they are giving out, so that's a good thing. So the share count was marginally down for the quarter overall, and for the year down over 2%, 2.4% for the whole year, which is good to see. Repurchasing those shares, making the share count go down. You'll notice in a lot of Silicon Valley companies, a lot of US tech companies, so many shares issued that it's just ridiculous. So it's good to see that Alibaba, a more mature company, is repurchasing shares, and they're willing to do that over time. The repurchase program goes to 2025, so there's a lot more repurchasing to come. So good news in terms of cash is they have $58.1 billion worth of net cash. That's over and above any long-term debt, which is an amazingly good cash position to be in. In fact, that represents about 27% of the recent overall market cap of the company, just in cash. So under the current buyback program, they still have $19.4 billion US dollars worth to buy back until March 2025. You could say with the amount of cash they've got and the amount of cash they're generating, they could extend that. They could do more if the share price stays low. You don't want to see a company buying back shares too expensively. There's no point in that. It's a waste of money. They might as well do something else with the cash, reinvest it. But reinvesting it in themselves while the share price is undervalued or undervalued as the management sees it, that's a good time to buy shares. Alibaba generates a whole lot of cash compared to its current market capitalization, so it's good that they're buying back shares. But they have got things to do with their money. These business segments that are going to IPO, they need funding, they need money when they IPO to get to that profitability stage. As I said earlier, in the next episode, I'm going to talk about those 6 business units that they're planning to IPO one by one. I'm going to put a link to that. If you're on YouTube, it'll be here, or in the meantime, if I haven't made it yet, there'll be a video that YouTube thinks you should watch next, but I'll come back and put that here. I'll also put a link to that in the description for those not on YouTube. Thanks for watching or listening, and I'll see you next time.